Today, the financial world is buzzing because an analyst just dropped a bombshell prediction Tesla stock is worth $2,400 right now. That's not a long-term estimate, not a 5-year projection today. And naturally, this has shaken Wall Street and left investors wondering whether this is an opportunity of a lifetime or a dangerous overreach. Let's break this down step by step. First, let's look at why this prediction is making waves. Tesla has always been a company that sparks debate. Bulls see it as the future of transportation, energy, and technology all rolled into one, while skeptics argue it's massively overvalued. So when an analyst comes forward and says the fair value is $2,400 today, they were not just throwing out a number, they're challenging the entire market's current perception of Tesla. And that's why this headline matters. Now, does Tesla have the fundamentals to back this up? This is where things get interesting. The company has shown explosive growth in production, deliveries, and expansion into new markets. From electric vehicles to energy storage and AI-driven autonomous driving, Tesla is not just a car company, it's a technology ecosystem. If you believe in the future of EV dominance, then suddenly $2,400 doesn't sound impossible. Investors often forget that valuations are forward-looking. They price in potential, not just present numbers, and Tesla has been the poster child of that philosophy. But here's the catch. There are very real risks in buying into this hype. Tesla isn't operating in a vacuum. Competition from legacy automakers and new startups is heating up. Economic conditions like high interest rates and inflation can crush consumer demand, especially for big-ticket items like cars. And then there's the issue of valuation itself. Even if Tesla is a leader in innovation, a stock price that far exceeds current earnings always carries the risk of crashing back down when expectations aren't met. Betting on $2,400 could easily turn into holding the bag if the narrative shifts. So what should investors do with this information? The smartest approach isn't to blindly follow bold predictions, but to use them as signals. A prediction like this tells you that sentiment around Tesla is heating up, but it doesn't mean you should throw all your money into the stock. A balanced strategy might involve diversifying, using dollar cost averaging, and always weighing risk against potential reward. The real danger is in chasing hype without a plan. At the end of the day, whether Tesla ever hits $2,400 or not, this story is a reminder of how quickly markets can shift. Bold predictions get attention, but disciplined investing builds wealth. The first thing that makes this prediction so shocking is the sheer boldness of it. An analyst stepping forward and saying Tesla stock is worth $2,400 today is not a small claim. It's a statement that directly challenges the market's current pricing. As of now, Tesla trades far below that level, and by assigning such a high valuation, this analyst is essentially suggesting that Wall Street is either missing something major or undervaluing the company in a dramatic way. That's why this number has captured so much attention. When an expert makes a call that differs so sharply from the consensus, investors start asking themselves, what do they see that others don't? Is this a visionary outlook, or is it simply reckless optimism disguised as analysis? To put it in perspective, most analyst price targets hover much closer to the actual market price. They may lean bullish or bearish, but rarely do they come out with such an aggressive figure. So when someone goes as far as $2,400, it's almost like they were planting a flag in the ground saying the market is wrong and here's why. That level of confidence sends shockwaves through financial media and investor communities because it forces everyone to revisit their assumptions. Suddenly, Tesla is not just another growth stock. It becomes a litmus test for how much weight investors give to innovation, future potential, and disruptive business models. But what really fuels the shock is Tesla's history of proving people wrong. For years, skeptics doubted its ability to scale production, remain profitable, or fend off competition. Yet time and again, Tesla has managed to break through barriers and outperform expectations. That history makes this analyst's call even more intriguing. On one hand, it seems absurd to claim the stock should be worth more than double its current price. On the other, Tesla's track record shows that bold predictions around the company can't be dismissed outright. This is why so many investors are paying attention, not just because of the number itself, but because of what it represents, a bet on Tesla's ability to keep rewriting the rules of the auto and tech industries. Ultimately, the shock factor comes from the clash between traditional valuation methods and the disruptive narrative Tesla embodies. Traditional analysts rely heavily on earnings, ratios, and comparables. But this call leans on the idea that Tesla is in a category of its own where old rules don't apply. Whether or not that's true is still up for debate, but one thing is certain. The boldness of this prediction has put Tesla back in the spotlight and reignited the debate about how to value innovation in real time. When evaluating Tesla's stock against this $2,400 price target, it's crucial to separate hype from fundamentals. Tesla isn't just any company. It operates at the intersection of automotive innovation, energy solutions, and cutting-edge technology. Its growth has been nothing short of remarkable, particularly in vehicle production and deliveries. Over the past few years, Tesla has ramped up manufacturing capacity, opened new gigafactories across the globe, and consistently increased output, which translates directly into higher revenue potential. Investors who focus purely on earnings today may miss the bigger picture. Tesla is pricing in future dominance in multiple sectors, not just current performance. Tesla's innovation pipeline also plays a major role in justifying such an ambitious valuation. From its expanding lineup of electric vehicles to the potential of autonomous driving software, energy storage, and even AI-driven products, the company is positioning itself as a technology powerhouse. Each innovation not only opens new revenue streams, but also strengthens Tesla's ecosystem, making its customers more engaged and dependent on its products. This integration of technology and transportation is something few other companies have achieved, and it creates a unique competitive advantage that analysts might see as underappreciated by the broader market. Profitability trends also warrant attention. While Tesla's earnings can be volatile, the company has shown an ability to scale efficiently and improve margins over time. Operational efficiency, cost reduction through battery technology, and strategic expansion into international markets have contributed to stronger profit potential. Analysts projecting $2,400 are likely factoring in these improvements alongside future growth, betting that Tesla will continue to dominate not just as a car manufacturer, but as a global technology and energy leader. Yet it's important to balance optimism with realism. High valuation multiples mean that even small missteps, slower delivery growth, production bottlenecks, or regulatory hurdles can significantly impact investor sentiment. The $2,400 target doesn't ignore risk. It reflects a calculated belief that Tesla's fundamentals, combined with market perception of its future, can sustain aggressive price growth. Investors need to recognize that such valuations are inherently forward-looking. They're betting on potential rather than current financials, which requires confidence in Tesla's ability to continue innovating and scaling in an increasingly competitive landscape. In short, understanding Tesla's fundamentals is key to assessing whether this $2,400 valuation makes sense. The company's robust growth, relentless innovation, and expanding ecosystem provide a rationale for the bullish prediction, even if it feels extreme compared to current market prices. For investors, the lesson is clear. Look beyond present earnings and consider the transformative potential of companies like Tesla, but always weigh it against the inherent risks of overvaluation. While Tesla's growth story is compelling, there are significant risks that investors must consider before buying into a $2,400 price prediction. One of the biggest concerns is competition. The electric vehicle market is no longer a niche segment dominated by a single player. Legacy automakers like Ford, General Motors, and Volkswagen are investing heavily in EV production, while startups such as Rivian and Lucid are targeting premium segments with innovative offerings. Tesla's first mover advantage may give it a head start, but as the market matures, margins could compress and growth may slow. Analysts projecting extreme valuations are assuming Tesla can maintain dominance despite this mounting competition, a risky bet. Another factor is economic uncertainty. High interest rates, inflation, and fluctuating consumer demand can have a direct impact on Tesla's sales. Electric vehicles are still a relatively expensive purchase, and economic downturns or tighter credit conditions can significantly reduce demand. Even if Tesla's products are technologically superior, external macroeconomic pressures could prevent the company from meeting growth expectations. Investors need to remember that market timing and economic cycles play a huge role in stock performance, and predictions like $2,400 often assume ideal conditions that may not materialize. Valuation itself is another critical risk. Tesla trades at a premium relative to traditional automakers, and its current price already factors in a lot of optimism about future growth. A $2,400 valuation implies not just continued success, but near perfect execution across production, innovation, and market expansion. Any misstep, whether it's production delays, supply chain disruptions, regulatory challenges, or missed revenue targets, could lead to sharp corrections. The higher the valuation, the smaller the margin for error, which increases volatility and risk for investors chasing such lofty predictions. Investor behavior also introduces risk. Bold price targets often drive speculative trading rather than informed investing. When markets react to headlines instead of fundamentals, stocks can swing wildly. Tesla has a history of dramatic price movements based on news, tweets, or analyst calls, which can amplify risk for those entering at the peak of hype. Emotional investing can turn potential gains into losses very quickly. Finally, technological and operational risks cannot be ignored. Tesla's future growth hinges on its ability to deliver cutting-edge products, scale global production efficiently, and maintain quality. Any failure in these areas could derail expectations, regardless of market sentiment or media hype. In summary, the $2,400 prediction may be exciting, but it's accompanied by multiple layers of risk: competition, economic uncertainty, valuation extremes, speculative behavior, and operational challenges all create a complex environment where even a strong company like Tesla can face setbacks. Prudent investors need to weigh these risks carefully before making any decisions. So, with all this information, the bold prediction, Tesla's strong fundamentals, and the significant risks, what should investors actually do? The first principle is to remain disciplined and avoid letting hype dictate your decisions. When headlines shout that a stock is worth $2,400 today, it's easy to get swept up in the excitement and think you're missing out on the next big opportunity. But successful investing isn't about chasing the loudest predictions. It's about evaluating risk, understanding the company, and having a plan that protects your portfolio while still allowing for growth. A practical approach is diversification. No matter how confident you are in Tesla's future, putting all your capital into one stock is extremely risky. Diversifying across multiple companies, sectors, and asset classes helps reduce the impact of any single prediction turning out wrong. Even if Tesla reaches 2,400, a diversified portfolio ensures that you're not overly dependent on one outcome. This strategy is particularly important when dealing with highly volatile stocks like Tesla, which can experience rapid swings in price based on news, sentiment, or broader market conditions. Dollar cost averaging is another strategy worth considering. Instead of buying a large position all at once in anticipation of the stock hitting a new high, investors can gradually invest over time. This approach reduces the risk of buying at a peak and allows you to take advantage of price fluctuations. It's a disciplined method that balances exposure to potential gains with protection against sudden drops. Risk management should also include setting realistic expectations and knowing your exit strategy. Decide in advance how much you're willing to risk and at what point you might sell if the stock doesn't perform as expected. Bold predictions like $2,400 can generate strong emotions, fear of missing out or greed, but having clear rules for your investments helps prevent decisions driven by emotion rather than logic. Finally, investors should focus on long-term potential rather than short-term headlines. Tesla's value proposition extends beyond today's price. It's about innovation, market positioning, and future growth. By understanding the company's fundamentals and risks, you can make informed decisions that align with your financial goals, rather than reacting impulsively to every news flash. In essence, the smartest response to a bold prediction is not panic buying or selling, but measured, thoughtful action. Use the news as a signal to evaluate your portfolio, consider diversification, employ dollar cost averaging, and stick to your risk management plan. By combining careful analysis with disciplined investing strategies, you can navigate high-stakes predictions like Tesla's $2,400 valuation without exposing yourself to unnecessary risk. Position yourself to benefit from growth while protecting your wealth.